This body does not differentiate between big and small states. Everybody's justice has got to be done with the wisdom of this council.
The GST Council in its 56th meeting has proposed GST 2.0. The government is calling it as next generation GST reforms. Here are the quick facts. A two slab structure has been brought in the place of four slab structure. That is, we will have 5% GST and 18% GST tax slab in the place of 5, 12, 18 and 28% slabs. Secondly, education items like notebooks, erasers are placed from 12% GST to 0% GST. And most importantly, health insurances and term insurances will not have any GST on them anymore, while other health sector items are placed under 5% GST, and daily essentials like shampoos, butter, ghee are placed under 5% GST from earlier 12 and 18% GST. In the agriculture sector, tractors, tractor tires, spare parts, drip irrigation system, fertilizers have all been placed under 5% slab. And if you look at the picture, the electronic appliances like ACs, TVs have been brought under 18% GST from 28% earlier. And automobiles, which are less than 1200 cc and are shorter than 4 meter, are placed under 18% GST. And the meeting has brought an interesting 40% slab for sin goods and luxury goods. Here, they seem to have merged the earlier GST compensation cess into 40% slab rate. In case if you do not know what is GST compensation cess, we will talk about further in the video. And finally, the GST appellate tribunal is expected to be operational by the end of this year. That was quick summary of the meeting. Let us analyze the moves now. Firstly, the decrease in GST rates is going to increase the consumption demand because people will have more money now and hence they are expected to spend more. The present GST structure had an issue called inverted duty structure where the inputs were taxed more than the output itself. For example, let us assume that a car is being manufactured which will be placed at 18% slab, while the car alloys or spare parts were placed at 28% GST slab. Here, whenever a person would buy the car, the manufacturer would get the 18% tax, but however, he would have paid 28% tax earlier while buying the spare parts. So, the different amount of tax would be under input tax credit. So, manufacturer had to apply for the refund of the input tax credit to get that. Whenever there was refund delay, this would lead to something called working capital blockage. This refund delay or working capital blockage would often affect the manufacturing industries and MSMEs. So, by harmonizing this, we are expected to avoid the inverted duty structure. And we also had another issue called classification disputes. It was something like this. In the same sector, different items were taxed at different rates. This would lead to endless litigations. For example, cakes and bakery items were placed at 5 and 12%, while the biscuits were placed at 18% GST. The Parle and Britannia were manufacturing rusk and were placing it under 5 and 12% GST. However, the tribunal had said rusk comes under biscuits, not bread, hence it should be placed under 18% GST. This case went for a long time. So, such issues within a particular sector will be addressed now. However, all is not great. Let us also analyze the issues here. Firstly, with reforming GST rates, the government will also forego certain amount of revenue. The HSBC economists have estimated the foregone revenue will be around 1.43 lakh crore. However, the Revenue Secretary Arvind Srivastava says the net revenue implication will be of 48,000 crore. If you look carefully, he uses the word revenue implication and not revenue loss because he says the collections may dip initially, but with the increase in consumption and higher compliance, much of this gap is expected to be covered. When we looked at the stats of fiscal year 2024, the GST had collected over 21 lakh crores. The foregoing amount of 48,000 crores is expected to be somewhere around 2.2 to 2.3% of that annual GST revenue. So here is the opinion of Chandrajit Banerjee, the Director General of Confederation of Indian Industry. Moving to two slabs, plus simplifying refunds and MSME procedures, plus rationalization of rates is going to ease the compliance and reduce litigations, and in turn give businesses and consumers the much needed predictability. See, whenever something can be predicted, people will not be afraid to invest and people will not be afraid to consume as well. So, if we carefully observe, from today to September 22nd, when the GST rollout will be enforced, people are not expected to buy health insurances or term insurances. Right now, why would they pay 18% GST when they can pay 0% GST after September 22nd? And people are assumed to buy bikes whose engine capacity is above 350 cc because it is going to be expensive from September 22nd. And we also have an issue called GST compensation issue. See, for this, you have to understand the background story. In 2017, the states gave up their independent taxation powers to the center or to the GST Council. And in return to that, the center guaranteed 14% annual revenue growth for 5 years, that is from 2017 to 2022. To fulfill this 14% annual revenue growth, the center had created a special cess called as GST compensation cess. And this was put on sin and luxury goods. The money coming from this cess went into a pool, and from this pool, the money was given to states. But during COVID 2020, the GST collection collapsed and the cess fund was not enough. The center says, so you borrow money now. From the future cess collection, I'll pay the loans, whatever you will be borrowing. Finance Minister Nirmala Sitharaman says, by the end of this fiscal year, they expect the loans to be repaid. But the catch is here, with reduction of GST rates, higher consuming states like Maharashtra, Gujarat, Karnataka, Tamil Nadu will be foregoing a lot of revenue. With no GST cesspool, now since there is a separate 40% slab, the amount is not going to the cesspool. So whatever the money the states are going to forego right now, that could be 48,000 crore or 1.43 lakh crores according to HSBC. The revenue coming to higher consuming states is going to be affected. So the Congressman Jairam Ramesh says this is actually GST 1.5. We welcome the reforms. However, it can be true GST 2.0 only when states are compensated well. Former Finance Minister P. Chidambaram says, we welcome the reforms, but it is 8 years too late. And he has a very interesting questions. He asks, it will be interesting to speculate on what drove the government to make the changes. Was it sluggish growth? Was it rising household debt? Or was it falling household savings? Or is it because there is election in Bihar? Or is this a reaction to Mr. Trump's and his tariffs? Or it is a mixture of all of the above? So we went on and analyze certain data. We'll go one by one. The first question, is it because of the sluggish growth? The answer is yes. The private consumption, which powers 63% of Indian economy, has slumped from 8.5% in 2023-2024 to 6.4% in the first quarter of 2025. That means the private consumption has been lowered. Secondly, the nominal GDP growth has reduced from 10.8% to 8.8%. But when we looked at the real growth rate, it was 7.8%. Now, this stat meant that India is doing better in production, but India has a low demand. The second question, is it because of rising household debt and falling household savings? The answer is very interesting. Presently, our households have a lot of EMIs. It meant that the household financial saving is low, which is 5.2% in the present, is amongst the lowest in decades. So lower GST rate means rise in household consumption and rise in household savings. And the third question, is it because there is elections in Bihar? The answer would be always yes. Any government, any party, the answer will always be yes. And bringing Trump into the picture, is it because of his tariffs? The 50% duty has certainly affected Indian export growth. Now the export driven growth has become riskier. But however, with the GST reforms, it is expected that the domestic demand will be better. The answer to Mr. P. Chidambaram's question is Yes, sir, it is a mixture of all of the above. And in conclusion, if these reforms are implemented with efficiency and state centered trust, it can trigger a virtuous cycle of higher consumption, improved working capital for business, reduced litigation, and ultimately stronger tax buoyancy. Follow Insights IAS for more such content.